So obviously, if you're bearish on a stock, that's when you would initiate your bear spread. So what you're going to look for are channels down, preferably short term or intermediate term. Just basically, you're going to look for downtrends. And the best place to find downtrends and the highest probability of being right when you find a downtrend is when you find it in a larger downtrend. So let's take a quick look. So now we're looking at Apollo Group. Now, Apollo Group started to tank when a sector hunter put out an alert and said the entire sector is on bear status. And all of a sudden, Apollo, which is the leader of the group, started to tank. And you could see that it reversed its uptrend here. Now, for a bear spread, there are a number of times here where you could have taken a position. You could have been the more aggressive trader. You could have been kind of in between, waited for a little bit more confirmation. Or you could have been the conservative trader and waited till you saw lots of confirmation that this downtrend was in place. But there were a lot of places where you could have entered your position. Number one, what I'm going to show you in a minute is that there's a major level of support and resistance right here that was cracked. Now, if you're the more aggressive trader and you want to get in as early as possible, you might have initiated your bear spread right there. Now, keep in mind that since we have a level of support right here, used to be the old resistance level, broke out, now it's new support, broke down, now it's going to become the new resistance level. If you're kind of in between, you're going to wait till this bounces a couple times and then rallies right back up to this level. Now, what we did here for a downtrend line is we took one top, extended it to this top that you see right here, the next top, which is a little bit lower, and just extended it further. You can see that coincides with this major point that used to act as resistance, support, and then once support is violated, that's going to act as resistance again. So if you're kind of in between aggressive and conservative, you can wait till you get right about here, and when that happens, that's when you can enter your bear spread. There are other places to enter it that we'll get into in a minute, which are going to be anywhere along this downtrend or anywhere along this downtrend. You're going to see that major price points and resistance levels that we found here are going to coincide with this point right here. We'll get into that in just a second. Now, you can see that there was a major slice right through the support level. Now, if this was just a small slice through the support level, you might say, well, there was such a big breakout, maybe it's just consolidating, but this is a major slice. The market's telling you that this is a forceful slice right through the support level that you have here. So once that happened, we're starting to lick our chops as bears. And we know that this old support level becomes the new resistance level, and you can see that actually came into play right here. We'll talk about that in a minute. But what you want to do now is play this little intermediate downtrend. This might be considered a short-term downtrend, which is days to weeks. Now, this was actually a channel because you can see this is the channel line, this is the downtrend line. You can see that the stock seemed to bounce off of this channel line a couple of times. This downtrend, this channel line right here in this downtrend actually coincides with this line that we drew right here. You can see that this downtrend line was tested just about every single day. Just about every single day, the stock moved up and bounced and closed a little bit lower. So this is pretty much proven. So you can initiate your bear spread at any one of these points from 85 all the way down to about 75. Even at 75, you would have made about 15 points on this trade. Now, there are other downtrend lines that we can find in here, especially after this is proven. That would be for the more aggressive trader. They want to take advantage of possibly the bigger move, so they jump in early. But other people might want to wait, study the chart a little bit. They know that the sector is out of favor. They know that this uptrend has recently reversed lower. So you might just be sitting back and studying the stock. Now, when the market bottomed out in March, you could see that we found some support right here in Apollo Group. You might also note that this support coincides with this key level right here. There was some resistance. Looks like it was at about $65 a share. Market broke out. You can see there's some pretty strong volume here on the breakout. The old resistance level becomes a new support level a couple of times here. You extend that out, it's no coincidence that the market bounced at the same level over here 3 times. You can see that, now, when we're talking about a horizontal support or horizontal resistance, the closing price is the most important price, which is the bottom of the red body that you see right here. But whenever we're talking about a channel or an uptrend line or a downtrend line, which is basically diagonal support and diagonal resistance, The most important time are the intraday highs and lows. So you can see it looks like it's a candlestick, sort of like a wick, and it moved slightly lower intraday. So the market closed, when I say the market, I'm talking about this stock, Apollo Group, closed right here. But sometime during the day, it made it this low. And that's why we connect this line and make it the channel line within the major downtrend. So this is the downtrend line, and this is the channel line that's accompanying it. You can see once we extend that out, it's no coincidence that we get bounces all the way down into May. So even though we're looking at trading maybe a week or a month, we always have to look at the next bigger trend. It's one of the most important parts of analyzing a chart. And you want to always keep the key price points in mind. And you always want to look at several different indicators. You don't want to trade just based on 1, 2, or even 3 signs. You want to see a whole bunch of signs that are all pointing to the same thing. So what we have here is a major point of support. Now, why do we know just after being tested 3 times that this is a major support or resistance level? How do we know this is a key level? Well, you can look all the way back here and see that it acted as support here, 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 acted as resistance before it was able to break out on heavy volume. Now, remember why this happened. This heavy volume happened because there was so much buying. It took a lot to push this stock up. There were a lot of sellers right here at one point. And since there were so many sellers, it took a lot to push through that level. But the buyers are so confident that they spend millions and millions of dollars buying millions of shares of stock, pushing it right through that level, not caring how many shares the sellers had to sell them. Finally, that acted as the new support. That became a key level. You could see it bounced off of about 5 months later. And then once that was violated, that acted as the new resistance level. So once we establish that this is a key point, we have that level right here. Now remember, when we're in April and we're looking at this happening, remember, we're the more conservative traders. We're waiting to see more of a confirmation that people don't like the stock, that big institutions that control the price movement don't like the stock. So you want to be on the side of the institutions. You don't want to bet against them because you'll lose. You can see there's a major sell-off here. Now, I'm going to be thinking about this major sell-off for the next 6 months. Millions of shares are sold. You can see about 25 million shares exchanged hands that day. And it opened up about 10 points lower. Now, let's look for a couple of other clues. So you can see lower highs here after this massive sell-off. You can see it coincides with this support level that was tested 3 times. You can see that as the stock tries to recover, the volume dries up. That means this is not happening because there were so many buyers. That means this is happening, this price advance of about 5 points, is because there was a lack of sellers. Here, there are lots of sellers selling the stock off, nailing it. They nail it even further. You can see that these red bars indicate heavier volume than the green bars, obviously. Heavy selling all the way down to this level again. Now, they probably had this channel line in mind as we connected this low to this intraday low. Remember, you connect intraday lows when it comes to downtrends or uptrends, diagonal lines. So it's no coincidence that we bounced off of this level. So the sellers might have said, you know what, we knocked this thing down from 80 all the way down to $65 a share. Let's see if we could sell it a little bit higher. Stop selling. It's not that so many buyers came in, George Soros and Warren Buffett came in and started buying the stock. The sellers just stopped selling and they gave the buyers a break. Some people who shorted the stock are actually now buying it back to close out their positions because they know that it hit this channel line. But it's not a lot of trading going on right here. So as the stock moves up, remember what we said, volume equals validity. The stock's moving up, but it's not a valid move. There's no real conviction behind that move. You can see as the volume dries up, the stock moves up. That coincides with this old support level that was violated, and that means we know it's going to likely act as new resistance level. And all these things are happening at the same time. So we can draw a downtrend line here. We can connect where the market opened to this trend, to this high, to this lower high. And once that happens, you can also see in here there's what we call a doji. This is a candlestick that you would learn, internal strength systems students know what that means, and it's a pretty potent candlestick pattern that means that whatever trend is in place, which is a very short-term uptrend right here, it's usually a way to stall it. That would be the opportune time to come in and take a bearish position. So you're going to take your bear spread right here after you see all these things coinciding at the same time. Remember, always take a synergistic approach to trading and to analyzing the market, analyzing a chart. Always look at many different signals that are all pointing to the same thing to find the opportune time to take a position.
Check out how Ron matches options to Chris's analysis. We've got a bonus video online for you now.
That was great. I think you really, in a real concise way, showed people very easily how to identify a downtrend, especially a short-term downtrend.
Well, you know, one of the most important takeaways from this and anything else that we ever talk about at Tycoon is to be just as comfortable trading the downside as you are trading the upside. You want to profit from down moves. Sometimes down moves are incredibly obvious, and you might be wrong about a bunch of up moves happening, so sometimes you want to take both bearish and bullish positions in the market and hedge your entire portfolio. But using the bear spread is a way that you can position yourself, and even if you're wrong and nothing happens, you can still make money, which is why it's my second favorite strategy.
Well, it's,
next to the bull spread.
The flexibility of it is obvious. I mean, they're very flexible trades. They are very, very easy for an investor to do. I mean, we know that there's all sorts of problems with investors trying to get short.
Right.
And they're never advised to be short either.
Right.
I mean, when was the last time your broker called you up and said, hey, we got a stock here that we think you should short?
Yeah.
You know, the investor's really on their own when we're talking about trading the downside of the market. And if you are on your own, you definitely want to be in a safe position. And with the limited risk that the bear spread has, it's the best way for an investor to start learning how to play the downside.
And brokers and advisors don't usually tell you to get bearish on positions. Sometimes they do, but they're kind of out of their element a lot of the time. Take it from me. I was on Wall Street for 10 plus years, and they're kind of out of their element. They think it's unnatural or something to get bearish. So when they finally do, they get stung, and then it's one of those things where they say, I'm never going to do it again, and they start thinking about superstition and weird things, believe it or not.
No, I do believe it. I mean, I haven't seen Wall Street make money in a bear market ever. I mean, and on top of that, you know, the last bear market we had, I mean, how many sell ratings were there? I mean, you had, what, less than 2% of the stocks had sell ratings on them, and the market dropped 50%? Yeah. I mean, the thing is that, you know, the individual investor needs a strategy like the bear spread to take advantage of the downside.
I'll tell you, you know, the most money that I ever made for my clients was I was managing money from 2000 down to 2003. That's when I made the most money for my clients, and that's when I raised the most money because I had a lot of accounts transferred over to me because I was the only one who was bearish from 2000 down to 2003. So, I mean, anyways, you can make money, and what's important about making money on the downside is that when you make money from something moving lower, then at some point you're looking at a stock that's incredibly undervalued or an ETF or a sector that's incredibly undervalued, and if Sector Hunter comes out and gives you a buy alert on a specific sector, now you have lots of money to plug into that bargain price.
See, that's a great point, because what happens is as the market trades down, most people who are unprepared and not trading, they're not even hedged, let alone trying to take advantage of the downside movement. When they're not hedged, they lose everything they have.
And then when the opportunity presents
exactly.
itself.
So now the stock's down at a place where it hasn't been in 20 years, a great buying opportunity, you have no money. But the thing is, if you would use the bear spread, that could all change, and you could do it in a very safe way, and that's what I really like about the bear spread.
Right. I mean, number one takeaway for me is just that you don't have to be 100% right. Stocks, you're trading stocks, either you're right or you're wrong, either you win or you lose. Bear spread, you might be wrong about what you thought was going to happen, you could still make money. So next thing that we're going to have to cover is the rolling and the morphing. Ron's going to go roll around in some bear spread for a little while, and he's going to morph a lot for you. And basically what that means is the same thing it's meant every time we brought it up, which is, you know, when it comes to the price of an option, there are all these different variables that affect the price of the option, and that's what gives us the ability to be right and make money even when we were wrong about what we thought the stock was going to do. But the fact that we have all those different variables in there, these variables change as things happen, like time sometimes passes.
Yeah, well, time just about always passes.
From time to time.
From time to time, time passes.
It
that
just
is true.
happened while you were watching us. Sometimes moods change. I saw that.
Just went again.
Moods change. Sometimes people are more complacent or more fearful, so volatility changes. Mm-hmm. Now, we know volatility and time tend to impact the price of options every now and then, right?
For sure.
Now, and sometimes even the price of the underlying changes. That can happen too. So when all those things happen, or any one of those things happen, what happens is the different variables that you know, they change, and then it makes it less ideal for the position that you've put yourself in. So what you want to do is find the ideal position and just make a small adjustment to your position that you have on, and that's called rolling and morphing. So go roll around in the bear spread, and come back to me, and I'll see how you smell.
Sounds good.
Good.
Well, now you should all know how to identify a downtrend, especially a shorter term downtrend like the one we would use for a bear spread. Now, obviously, we're not looking for bear spread opportunities. What we're looking for is what we see on the charts, a simple downtrend. Now that we found our simple downtrend, we have our decisions to make. And if we so decide to choose the bear spread to trade this downtrend, let's talk about what we're going to do next. Next step, the setup. Well, let's think about buying a put spread. Let's do the bear put spread. If we are going to do the bear put spread, the first thing we have to do now is we're going to buy one put, then we're going to sell another put with a lower strike in the same month in a 1-to-1 ratio. Now remember, if we're going to try to pick this up as a premium collector, if we want to pick up some premium, the way we have to set this bear put spread up is by shorting or selling the at-the-money option. If we sell the at-the-money, then we know that we're going to be a premium collector. And in a bear put spread, if we sell the at-the-money, then we must buy the in-the-money put. What if we were deciding to do a bear call spread? We decided we want to do the credit side of the trade. Well, we're going to buy one call, then we're going to sell another call with a lower strike in the same month in a 1-to-1 ratio. Remember, if we want to set this up as a premium collector, we have to sell the at-the-money option, or at least be short the option that's closer to the current stock price. That'll ensure that we have the proper theta we need. So if we sell the at-the-money, and we're doing a credit spread, the bear call, we know that we have to buy the out of the money. Because if we buy the out of the money, we'll have spent less money than we brought in. That creates our credit. So there's your setup for either one of the two bear spreads. Let's take a look at the bear put example. We would buy one May 95 put, obviously an in-the-money put. And we would sell one May 90 put, obviously an out-of-the-money put. The one we're buying, the May 95 put, we're spending $7 for. The one we're selling, the May 90 put, we're bringing in $4. This is going to create a debit. This is the debit trade. What's our break even? Well, let's think about our rules. We said that break even for our bear put, the debit trade, was to go to the higher strike and subtract the cost of the spread. The cost of the spread here is $3. The higher strike is the 95. Grab your calculator, slide rule, whatever you need. 95 minus 3 is 92. At 92, we will break even. Let's take a look at that. At expiration, say the stock closes right there at 92. The 95 put will be worth $3, right? The right to sell at 95 versus the stock trading at 92. We could exercise our right to sell at 95 and then buy it back at 92. That's a $3 value. So we know the May 95 put will equal $3. The May 90 put at expiration would obviously be worthless. It's out of the money. Who wants to exercise their right to sell a stock at 90 that's trading at 92? So this put would be worth 0. If we have the May 95 put worth 3, the May 90 put worth 0, the spread is worth $3 with the stock at 92 at expiration. We originally paid 3. It's now worth 3. We're at break even. That's the math to double check that your break even is proper. What's our maximum gain? Well, we've got a $5 spread here. A $5 spread means that the maximum value of the spread is what? $5. If the maximum value of the spread is $5 and we purchased it for 3, that leaves us with a profit margin of 2. Our maximum gain is $2 in this spread. Our maximum loss, that's easy. We're a buyer of the spread. If we buy an option, what can we lose? Only the amount we spent. We paid 3. That's our maximum loss. We could lose all 3. What about a bear call example? We're going to buy one May 95 call, and we're going to sell one May 90 call. As you can see, we are buying an option that is cheaper than the option we're selling. the May 90 call is definitely going to be more valuable than the May 95 call. The right to buy at 90 is obviously $5 better than the right to buy at 95. It's a $5 wide spread. And we right now are selling this spread, aren't we? We're selling the more valuable option, the May 90 call, and we're selling it at $4. We're buying the May 95s for $2. So we've got 4 coming in from our sale, 2 going out from our purchase. This is a credit trade. We're bringing in $2. Bear call is a credit trade. Now let's take a look at our break even. Remember our rule for the break even for the bear call. What is that rule? Take the lower strike and add the value of the spread. This spread traded at $2. Our lower strike of the May 90 calls. 90 plus 2 equals 92. Let's do the math to check this out. Let's make sure that we have the right calculation. If at expiration the stock was 92, what do we have here? Well, right off the bat, we know our May 95 call will be out of the money and worthless. So that's done. What about the May 90 call? Well, the May 90 call will be in the money because the right but not the obligation to buy at 90 when a stock is 92 is worth $2. There's a $2 value there. So our May 95 call will be worthless, the one we're long. The May 90 call, which we're short, is worth $2. There's our break even because now the spread is worth $2 with the stock at 92. So that works out for us. That's the right addition. Remember, this whole thing with option theory is that it's a puzzle that has to be able to fit together mathematically. Anytime you put something like this together, you should be able to check it backwards. If you can't check it backwards, you've probably done something wrong. It doesn't hurt to take a minute before you put the trade in to check backwards. What's our maximum gain? Well, we sold something here. And we know that when we sell options, what can we gain? Only the amount we sold the options for. Here we sold a spread for $2. Our maximum gain? $2. What's our maximum loss? Well, think about the amount of risk we have. We have a spread here that's worth $5. Its maximum value would be $5. If the spread did go to 5 and we had sold it for 2, we will have lost $3. There's our maximum loss, $3. So, both spreads, as you saw, the bear put and the bear call, one the debit, the other the credit, synthetically identical, just showed that they have the same maximum potential loss, the same maximum potential gain, and at the same prices. And the nice thing about that is they're supposed to. So that works. What are our keys to success when we're putting on a bear spread? Well, obviously, start off with the first basic thing. And this is true every time. A bear spread is a particular trade that we use in a downward moving market. If we're not moving downward, we don't want to use a bear spread. It would be the wrong strategy, and we'd probably wind up losing money. So the idea is to figure out how to get a better idea of where the stock is going. Solid technical and fundamental analysis of the stock is going to give us a better hint that, hey, this stock is starting to trend down, or this stock is in the middle of a downtrend. Now we can be much more confident placing a bear spread on. If we have no idea where the stock is going, then putting on a bear spread is probably not a good move. We need to have better ideas of the likelihood or the probability of the stock going in a certain direction. Technical analysis is where we find this. Now, understand that both the credit side and the debit side of our bear spread can be set up to be a premium collector. Credit does not mean premium collection. We can set up a debit spread that's going to collect premium just as good as any credit spread. Understand that both are equal and view them that way. Don't become a puppet that only knows how to trade a credit spread. Make sure you understand there's another side of this. Because to be honest, I personally, and I'm not saying you need to do it, I personally like the debit side better because I normally do better at picking the right direction than I do in anticipating how far the stock can go. That means most of the time I'm in the right direction, but I wind up getting out too early. I always seem to either get out too early or not anticipate the length of the movement properly. I always underestimate. For me, the debit spread works better because as the stock is moving and I notice, oh my gosh, this thing's going to go down another 30%, and I'm limited on my profit side in this bear spread. I have an easy morph that you're going to see in a couple minutes. I have an easier morph to allow me to continue profiting even if this spread had already maxed out. So it really is a matter of what fits you better. But you know that both of these are the same. That exists for the bull spread also. Know that the debit side and the credit side are the same trade. Just get comfortable with both of them so you can use either one at any time. Remember, sell the at-the-money option guarantees that you're in premium collection mode and increases the probability of success of both the bull spread and the bear spread. Now, we know that buying a call spread is the same thing as selling the corresponding put spread. And obviously, in the bear side of things, buying the put spread is the exact same thing as selling the corresponding call spread. They're equal trades. Just do the most cost-effective one. And hey, don't be greedy. Don't wait for the last penny. You're not going to get the last penny out of these trades until Friday after expiration. If you've made the majority of money available in that spread, and you made it in 2 weeks, you bought the spread for $3, it's now trading at $4.60, $4.70, don't wait another week for that last 30 cents. Take it off, get rid of your risk, take your profits. There are many more opportunities. Don't wait for the last penny. Don't be greedy. Don't be stupid. Now, let's get on to trading the bear spread. Now that we have this bear spread on, we found the downtrend, we set it up properly, we now have it on. What are we going to do as the stock moves? First, what do we do if the stock goes down? Obviously, off the bat, we're in a bear spread, the stock is going down. How do you think we're doing from a P&L standpoint? If you said making money, you're more than likely right. So we're in a position where we're making money. Does that mean we should roll? Continue? Well, rolling is a continuation strategy. And if the stock is going down and we are in a position where we're making money, we probably want to continue to do that. But here's the thing. When we roll, if we roll the entire spread, we're going to have to do it as 2 trades. So a lot of people just roll their short option. They roll the short option to another strike that has a lot more premium. The only problem with that is as they roll the one option but not the other, they increase the distance between the 2 strikes. By doing that, yes, they may have increased their potential profitability going forward as long as the stock keeps going down. But now, instead of being in a $5 wide spread, they're in a $10 wide spread. We've increased our risk. I don't like this roll. I don't like doing that. I think that increasing the risk is the wrong idea. I think more, even especially the fact that I increased the risk, and now I stand a chance to lose more than I gained to begin with. That means I'm putting my money back in the market instead of trying to play with the market's money. So we have some potential morphs. Instead of rolling, I'd rather do a morph. The reason being, the roll is going to cost me 2 trades anyway. And if I feel like I have to roll the entire spread, and I'm going to be closing down each of my 2 options, and then opening up 2 more, I'd rather just close the trade and reevaluate afterward. If I have to move my short option down, that's 1, and my long option down, that's 2, I've got to do 2 trades. If I'm going to do 2 trades anyway, take the thing off, lock in the profit, take a deep breath with a clear mind, and reevaluate. In essence, all you're doing when you're rolling this spread is you're shutting the spread down and opening up a new one. but you're doing it in one fell swoop. All I'm saying is, if you got to do that anyway, close it down and take a step back. Relax. Now let's reevaluate. With the stock down here, do I still feel that it can go further? I might have been super confident when it was up here that it was going down to here. But now that it's here, am I just as confident that it's going now down to here? I don't know, but I'd like to take a look. And if I've got to shut the trade down anyway, let's close it and step back and breathe before we reinitiate. Because that's all we're really doing in the roll, except we're not reevaluating. We're not stepping back. We're not taking a deep breath. We're just jumping right back into it. I don't like the roll. Now, what about the morphs? Well, obviously, the position is working for me. Why would I want to change something working for me? Why? Because this bear spread is a limited profit trade. If the stock was trading down, we know at some point in time it's going to come up to a support. Normally, the stock will bounce off that support. It will support at the support. But every once in a while, a stock will break the support. And when it breaks support, we are now in a condition called a breakdown. And a breakdown is normally 3 to 8 days, maybe 10 to 15% on the stock. But 10 to 15% on the stock in 3 to 8 days is one hell of a profit opportunity. I don't want to be maxed out while this stock is breaking down. I need to remove my limitation on profit in this strategy in the case of a breakdown. I know I've already made money, but now a new opportunity has come to light. And that opportunity is one I don't want to pass up. I need to morph this trade. I'm going to change my debit trade. I'm going to go ahead and take my debit spread, and I'm going to change that into a short stock replacement and ride a long put down. If I'm in the credit side, I'm going to change that into a synthetic put and ride the stock down. And finally, closing is really not an alternative here. I mean, if the stock is going down slowly, we're making money in our spread. If the stock goes down slowly, then breaks support and gaps down, we're not only made money in our spread, but we have an easy opportunity to morph into something that will make more money. Why do I want to close this? I don't. If I read the downtrend correctly and got in the bear spread to begin with, odds are, if it's working for me and the stock is moving down, I've got a decent little feel here, don't I? I'm called. I called it right. The stock moved where I thought it would. Now, if I identify a support level and it breaks that support level, I'm probably more than likely going to be even right in a higher probability of chance. I got a feel. I'm in there. I'm reading the chart right. Other people are seeing what I'm seeing. The stock's moving. Don't close the position down. This is the time to parlay that. So let's take a look. We're in our bear spread. And which one are we in? Well, I guess the P's give it away, huh? We're in the long put spread here. This is our debit trade. First thing we know is if the stock is trading down, what do we want to do? Buy back our short option. See it? See our short option? Buy it back. If the stock starts to really gap down on a breakdown, it's this short put that's in our way. This is what's limiting our profit potential. If we can get rid of that, then our long put, this one right here, has free ride the whole way down. Buy back. That's all. Just buy the short option back. Don't worry that you're paying more for it. It doesn't matter. The spread has made money. Too many people don't do this because if the stock did go down originally, then this short put here will be more expensive. But your long put will have gained even more than that. We are already in a point of profitability. Make sure you see the whole team. The spread has made money. This one has made money. This one has lost money. But this one made more money than this one lost. Don't be afraid to buy this back at a loss in this single option. You're still overall profitable. Buy it back and play this long put on the way down in stock replacement mode. What does that mean? We were in a bear put spread. We've now bought back our short option. We're in stock replacement. We're rolling now. Lock in our profits, lower our risk. We now trade it like stock replacement. What if we're in the bear call spread? That is obviously the credit side. Well, if the stock starts trading down, which option is in our way? Which one is not functioning for us? The long call. It's the long call that's hurting us here. We can't just sell that out because what does it leave us with? Oh, yeah, it leaves you with major medical bills. You know, the burn, hair replacement you have to worry about. I'm sure the bat's going to dent your skull somewhere. You can't be naked short the option. So even though this long call is a thing that's hurting us, we can't sell that out and leave us naked short a call. That's unlimited risk. We can't do that. We've got to figure out another way. And that means we have to rely on our knowledge of synthetics. What if we looked at that short call and added a long put next to it in a one-to-one fashion? The strike where we have the short call, we buy the corresponding put one-to-one. When we do that, what did we set up right here? We set up long put, short call, one-to-one ratio, corresponding options. That's a short stock position. We're now short stock here. The 65 strike is no longer an option. It's a short stock position. We're short stock and long a call. Short stock, long call, one-to-one ratio. We've just turned this June 70 call into the June 70 put. We're in a synthetic put position with the stock breaking down, exactly where we want to be. Now, what if the stock goes up? Remember, sometimes not losing money is just as important as making it in the first place. Stock is going up, we're in the wrong position, aren't we? Now, if we're in the wrong position, do we want to continue to be in the wrong position? We're now losing money. Shall we continue to lose money? Obviously not. A roll is not something we want to do here. Why don't we want to roll? Because we're not in the right position. I don't want to continue the wrong position. I want to eliminate the wrong position because I was wrong, and I want to turn it around and get into the right position. That means I've got to morph. We're going to take our debit trade and turn it into a protective put strategy, and we're going to take our credit trade, if we decided to do a credit, we're going to change it into stock replacement with the stock running up. Closing alternatives. Hey, when you're wrong, you can always get out. If you're not feeling it, you could just close it down, walk away, do something else later. But if we see that this stock has turned on us, and it now looks like it's going up to break the upside resistance and could break out, we definitely don't want to be in a bear spread. We've got to change that. So let's take a look at the first change. Here we are. This is obviously our bear put spread. This is a debit trade. What are we going to do? First off, which option is hurting us? We're in a bear spread, and the stock is going up. It's this long put that's hurting us. Can we just sell out the long put and leave the short put there naked? We can't do that. We've got to do something else. What can we do? Well, we could take a look at our short strike, and we could say, look, we're short that put there. If I go to that put's corresponding call and buy it, I now am long call, short put, corresponding options, one-to-one. Long call, short put is now long stock. I've now turned my short put into a long stock position in the 65 strike. There are no more options in the 65 strike. That is long stock. Long stock plus long put, because remember, my 70 is still here. Long stock plus long put equals long call. I've turned my June 70 put now into the June 70 call. And with the stock running up, the June 70 call is definitely where I want to be. What if I was in the bear call spread? What am I going to do? Well, obviously here, you can see that we're in the call spread, and this is a credit trade. The stock now is trading up against me. Before it gets away from me too far, I think I need to do something here, because if I stay in my bear call spread, I'm going to lose money. And that's not the name of the game here. The name of the game here is making money. So what am I going to do? Well, I take a look at it and I say, first, with the stock running up, which option is hurting me? The short call. This makes things easy. The short call's hurting me. What can I do? I can simply buy back the short call. If I buy back the short call, I'm left simply with the long call, with the stock running up. I'm now in a stock replacement call position. And what can I do? And what do I need to do? As far as the stock runs up, I start rolling that call up with it. You've got to be comfortable with these different positions, because we're going to be changing them on the fly. That is how floor traders do it. That's why floor traders always seem to be in the right position at the right time, because they understand where they need to be and how to get there quickly. We're not always right. Us floor traders, we're wrong more than once, on several occasions. I don't want to go far as all the time, but we're wrong a lot. The fact is what makes the difference here is that we can understand we're wrong, not get all flipped out in the head about being wrong, and make the move necessary quickly, easily, and efficiently to get us from being in the wrong position to being in the right position. That's what morphing is all about. Now, obviously, we can always close. And what we have to realize is that we can close in two different ways. We could simply wipe the trade off the board, or we could do the opposite spread. Remember, if I'm short the call spread, all I need to do is then sell the corresponding put spread. Short call spread, short put spread, box. I am arbitraged out. I have a position with no position. Now, what if the stock stays still? Here I am. I'm in my bear spread. I'm expecting the stock to go down. The doggone thing isn't moving. Well, I do have a potential roll, right? Wrong. The stock not moving with me in the right bear spread is actually a good thing. If I constructed the spread originally as a premium collector, the lack of movement is going to benefit me. I'm collecting premium. Yeah, the stock going down makes it easier for me to make money, and I'll make money faster. But if the stock doesn't move, I'm still going to be making money. And if I still believe that there's an upcoming downward movement or a continuation of a previous downward movement, I'm in no rush. Time going by doesn't hurt me. I can wait it out. I can be patient to see if I get that downward movement, because with the stock not moving, I'm collecting premium. So I'm in no rush to roll this or change it in any way, because we're staying still. Now, what about morphs? Different story now. What if it's staying still and I look at it and I say, you know what? I thought it was going to continue going down. It looks like it's consolidating here. My opinion now has changed a bit. I don't see more downside. I don't necessarily see upside. I see sideways. What can I do? Well, I can change this position into a butterfly or a condor, a premium collector that's extremely powerful, but it's a delta neutral trade. So now if I get myself into the butterfly or the condor, I don't have to worry about direction in either way. I really get a chance to focus in on some serious premium collection in a sideward moving stock. We'll take a look at that in a second. If the stock's staying still, it's definitely not a good idea to close. We have the potential as a premium collector in our premium collection bear spread to continue making money while the stock isn't moving. We can wait it out. There's no reason to close. If the stock goes sideways and it looks like it's going to be a continuing sideways pattern, we can change into a butterfly or condor. There's no reason at this moment in time to close this position. Well, here we are with our bear put spread, our debit trade. Long, hopefully, the in the money put. Short, the at the money put. Short, the at the money put means we're in premium collection mode. If by chance we decide that the stock is going to continue going sideways, all we need to do to get ourselves into the butterfly or condor is this. Buy, we're already right here long the put spread. We're long the 65.70. Just simply sell the 60.65 put spread. By doing that, we've got two long spreads here. And what do? We wind up being in our butterfly in a very powerful premium collection mode. We're going to be short two at the money options now with upside and downside protection. If I'm in my bear call spread, what am I going to do? Boom, I'm going to add this call spread in there. By doing that, I throw myself into a butterfly. This is a call butterfly. What winds up happening now is I have some very powerful premium collection going on because I'm not just short one at the money option, I'm short two of them. I've got upside and downside protection, so that way wherever the stock goes, I am in a limited risk position. Bear spreads, again, bear put spread. I don't like the butterfly for some reason. The stock is in between the two strikes, and I've decided to, instead of going with the butterfly, I've decided to lock the thing down. I am not happy with what I'm seeing. The stock is going sideways. I've just shut it down. Is this something that I would personally do? Probably not. But see, I'm not you and you're not me. You need to know that if the thing isn't going down and you really expected it to, and you're not sure what's going on now and it's going sideways, you could always get out. Like they say, when in doubt, get out. Bear call spread closes down. We could either wipe the position off or we could turn around and do what? The corresponding put spread to close us down. Now, obviously, there's a lot of opportunities with the vertical spreads. And recently, the bear spread has become very popular because we've had a major down market. The bear spread allows us to very, very cheaply, incredibly cost efficiently, take advantage of a market that's going down. And because it allows us the cost efficiency, we can now play stocks that were way too expensive for us to play in a normal fashion. Obviously, way too expensive for us to play the stock, and potentially too expensive for us to even play a stock replacement strategy. The bear spread is a great strategy to come in to take care of the fact that the stock is expensive. We also know that in high volatility situations, a properly constructed bear spread is going to be able to take advantage of the probability of volatility coming back down, reverting to its mean. It's a very flexible strategy, and it is one that every investor should have in their trading arsenal.
Excellent job. Once again, I could have done it better, personally, but you did all right. You did decent that time. Not as good as the last time. But we're going to close out the bear spread, and it's important that you know that you can make money on stocks moving lower just as easily as you can make money on stocks going higher or ETFs going higher. But you can also profit from them moving sideways. And one of the best ways to do that is with the time spread, which is what we're going to cover next. You can profit from a change in volatility, either an up move or a down move in volatility. And you're going to do that with the time spread. But before you pop in that DVD, go to the community, hang out with your friends, say what's up to your peers, answer questions, whatever you feel like doing. And I also want you to take the quiz. Don't forget you have to pass the quiz before you're allowed to pop in the next DVD. And then when you pop in the next DVD, I'll be here waiting to welcome you in time spreads. So I'll see you there.
Well, Chris has found an opportunity to possibly get short a stock here, and that stock is going to be APOL, Apollo Group. Only problem is, it's an $80 stock. So even with stock replacement, this still might be a little expensive for a lot of you to try to get short. So what do? We look into a spread, in this case a bear spread. We're going to try to take advantage of the stock going down. And we're going to do it in a cost-efficient way. Not everybody has Bill Gates' capital. So what are we going to do? We're going to do the bear spread. Anybody can do it. It's cost-efficient, it's very safe, and it provides a pretty good percentage return when done properly. So with the stock at 80, I'm going to look at first the put spread of our bear spreads, the debit trade. I'm going to look to buy the 85 put, the March 85 put, and sell the March 80 put. By selling that March 80 put, we're going to be in a premium collection position. One of the reasons we bought the 85, sold the 80, is so that we were selling the at-the-money option. Whenever you sell the at-the-money option, and you are directly at the money here, you have guaranteed yourself a high probability outcome, because now we're not only going to make money if the stock does trade down like we're expecting, but we're going to make money if the stock stays still. So we're buying the March 85 put at $8, selling the March 80 put at $5. A debit trade, it is our bear put spread. But there's another way of creating that bear spread, and that's using the calls. A bear call spread. That's going to be a credit trade. Same idea. I want to be a premium collector. So what am I going to do? I'm going to sell the March 80s. But now I'm going to buy the March 85 calls. If I sell the March 80s for $5.20 and buy the March 85s for $3.10, I have put myself in a position where I'm going to be collecting premium. I am, again, short the at-the-money option, where the heavier amount of decay is. And on top of that, I am still in a high probability trade. I make money if the stock stays still because of the premium collection. I make money if the stock goes down because of my directional bias of the bear spread. So both trades work in the exact same way. You know how to figure out which one is more cost effective than the other. All you have to do is go back to the notes on the box to figure that out and do the one that has the optimal pricing. If they're in line, do whichever one you want. Both the credit spread and the debit spread, doesn't matter. They're both going to be equal, and you're going to make money or potentially lose money in the same way. So Chris selected M, 3M, it's a mining company, as you know, 3M company, as his bull spread choice. So let's get this exact position constructed a la Chris's finding of our opportunity here. Well, when we're looking at this, first we have to know where is the stock right now. Right now the stock is $48.65. We do have a few choices. $48.65 does fall between a couple strikes. There's a couple strikes we can play here. Most commonly, the 45 and 50 strike. If we were to do a bull spread, we are going to first buy, and we're going to do the call version here first. We're going to buy a call with a lower strike than the call we sell. That means we'll be buying, say for instance, the April 45 calls and then selling the April 50 calls. Let's take a look at that trade. If we have to buy the April 45 calls with a market of 440 bid offered at 460, we would pay $4.60 for the April 45 calls. And I'm just going to go bid to ask so that we can get this done. If not, we'll be playing in between all day long. But we're going to buy these at 460, and then we're going to sell the April 50 calls for $1.40. By doing that, we've incurred a debit. This is going to be a debit trade. How much of a debit? $3.20. Paying $4.60, bringing in $1.40. Now, we have now paid $3.20 for a spread that is $5 wide. The maximum value on this spread is $5. We've just paid $3.20 for it. If the stock finishes 50 or above, then the value of this spread will go to $5. We paid $3.20. We would make $1.80 on our $3.20 investment. Not too bad, huh? If the stock were to go against us, and we did nothing, because I know that all of you are going to morph if it would go against us, but if we did nothing, and the stock went down and closed at $45 at expiration, this spread here would go to zero. Why? Because the April 45 calls would be worth nothing with the stock at 45. The April 50 calls obviously worth nothing with the stock at 45. Thus, the spread is worth nothing. And since we paid $3.20 for a spread that is now worth nothing, we have lost that $3.20. On the other side, we might decide, hey, I don't want to do the debit spread. I want to do the bull spread, yes, but I want to construct mine as a credit spread. Then we'd have to look over at the puts, because now we have to sell the put spread. So what are we going to do? If we're going to sell the put spread, we're going to sell the higher striked put and buy the lower striked put. If we keep it consistent and we use the corresponding spread, we would sell the April 50 put for $2.70 and then buy the April 45 put for 90 cents, which gives us what? 270 minus 90, 180. Wow, isn't that curious? How we can only make 180 from our debit spread, and our credit spread only lets us make 180. Guess that means that the box is in line. There's no advantage here to doing either one. You could do whichever you want. So say if we did sell the April 50 put for $2.70, buy the April 45 put for $90. That means we have a $1.80 credit coming in. What's the most we can make? The $1.80 that's coming in. And where do we make that? Right at the short strike, the 50 strike. If the stock is 50, we make our $1.80 in the credit spread, just like we make our $1.80 with the stock at 50 in our debit spread. How much can we lose? Well, we know it's a $5 spread, right? $5. 45, difference between 45 and 50, $5. We have just sold it for $1.80. What's our total maximum loss? Well, it could go to 5. If it goes to 5 and we sold it at $1.80, we have a $3.20 loss. The same potential loss that we would have over here in the debit spread, and at the same price, right? The same stock price. What is that stock price? That's right, the 45 strike, the strike of our long option. So that's our bull spread.